We have a great presentation lined up for today, and we'll be offering 1 hour of CPE. To receive CPE, you must answer at least 3 polling questions and attend for the full 50 minutes. If you have any questions during the webinar, please type those into the Q&A window located in the bottom control panel. CPE certificates will be issued via email within 10 days. If after 10 days you have not received one, please email cbhlearning@cbh.com. A recorded version of this webinar will also be available in about a week. It'll be sent via email and also posted to our website. Just note that at the end of the session, we will be sharing a short survey to gather some feedback. And with that, I am pleased to introduce Chase Wright, partner with Risk and Accounting Advisory Services, along with Jessica Helms, Cherry Bekaert Senior Manager with Assurance Services. Today, we are also delighted to have Wesley Williams, Accounting Manager at Lease Query, joining us. We have a lot to discuss today, so please, Chase, take it away.
Great, and thank you, Maddie, and welcome everyone to the webcast. We appreciate everyone attending. We're wondering how relevant this topic might be, and then we had about 550 registrations for the webcast, so we can appreciate the relevance from the attendance. So glad you're here. We continue to work with a lot of clients to adopt this lease standard. It's such a holistic change to any reporting company under GASB or GAAP. One question we had was, is there any small company exception? The answer is no. This is a holistic standard that everyone must adopt. So we have a comprehensive agenda that we have created. The first is deadlines and impacts. You know, what you need to know, what are these deadlines and impacts? You know, they're right around the corner. We continue to have a lot of questions come in. Please feel free to ask questions as we go here. We'll try to address each one that we get. The next is application of the standard. What's a lease, and what's the impact that you have on your financial statements? One tricky area is identifying embedded leases and a service agreement that you may not be thinking about. We'll cover off on that. That's a real area that we spend a lot of time on. And then let's talk about practically implementing a lease standard. You know, how do we do it? What's our approach, et cetera? It's great to have Wesley here. There are a lot of very good software options that can accompany the technical approach to adopting the lease standard. So we definitely want to give that consideration. So Wesley, glad to have you here. And with that said, we'll start our presentation. And I think Jessica Helms is first up. And Jessica, are you starting with a polling question?
Thanks, Chase. Yeah, we're going to start with a polling question. So what is your primary purpose for attending today's webinar? You think this is an interesting topic? You think we might be knowledgeable presenters? You're just here for the CPE credits? Or is this maybe required for your job?
And everyone, while we're waiting for the polling to close, I thought it'd be a great time to maybe address some of the pre-questions we had prior to the call. And just going down the list here of questions, it seems like Chase answered the first question. Is there any exceptions for small or medium business? But maybe Jessica, maybe help answer this question here is, you know, how do you determine incremental borrowing rate for a private entity?
Yeah, that's a good question. One thing to keep in mind for private companies is that there is the option to use the risk-free rate as the incremental borrowing rate. So we are seeing that used a good bit. Generally, that'll be a lower discount rate to use. So you might end up with a higher asset and liability number, but it does take a lot of the guesswork out of trying to figure out which other rate you should use. Another thing that we've been seeing is even if you don't have any debt that's truly comparable to what may need to be used as the incremental borrowing rate, you can still take any existing debt that you have and the interest rate there and adjust it for different factors, whether it's collateralized or the lease term or the amounts, and use that just as a starting point. And then another option, we've seen some people actually going to their banks and asking them, what would a discount rate be, or what would the interest rate be for us to borrow this amount of money? So there are a few options there.
Thank you. And so that was perfect timing, Jessica. It looks like we have the results to our first poll. Looks like coming in close between required for job and interesting topic. Interesting topic being 34% and required for the job being 33%. Glad to know everybody this is a relevant topic for everyone. So I think we're going to get a lot out of today's call, and then following behind it, CP credit and knowledgeable presenters. So we'll move on into the next piece here.
Yeah, so first I just want to give a little background on why the FASB decided to issue this standard. So back in 2005, the SEC requested that the FASB look into off-balance sheet arrangements related to leases. And what they found is that since operating lease commitments aren't recorded as liabilities, there were huge amounts of leases that were not on balance sheets. And then in 2015, this was actually estimated to be around $3 trillion worth of operating leases just for publicly traded companies that were off balance sheet. And the FASB felt that, especially due to the size of this number, that this could be misleading to investors. And so this is really how we got to the point where they thought a change in lease accounting was needed. And the goal of this change was to increase transparency and comparability. And the main change is that operating leases will now be recorded on the balance sheet. And the new standards are much more principles-based than rules-based, and really just trying to make the economics of each transaction match the accounting, instead of companies trying to play games just to keep their leases off of their books. Since almost 90% of leases weren't included on the balance sheet, it could be difficult to see the true financial position of a company because their lease payments weren't shown as liabilities. So now all leases have to go on the balance sheet to improve transparency. And then it could also be difficult to compare different companies under the old standards because two very similar leases could end up being recognized very differently if one was treated as operating and one was treated as capital. So now there's less difference in how those leases are recognized. There are more disclosures required to really help the users of financial statements have a better sense of the economic position of each company that they're looking at. And so looking at the deadlines, when do these changes need to be made? For most private companies, you'll need to adopt starting January 1st, 2022. And we've obviously passed that date. But really, if you'll be going through an audit, it's likely for your December 31, 2022 year end. So that's really when this will all need to get audited. But we definitely recommend starting as soon as possible now, because it can probably end up taking longer than you would expect. And one thing to note is that under ASC 842, you can choose to recognize the new standard either in the current year or retrospectively. And what we're seeing is that most companies are choosing to adopt starting with the current year, meaning that you might have differences in your lease accounting between the current year and the prior year in that first year. So you may see 2022 under the new standards and 2021 still following the old standards. So getting a little more into the details of how is this really changing the accounting here? So for existing capital leases, it's a very limited change, and it's mainly just a title change from capital lease to finance lease, and then capital leases become right of use assets. There's no real changes in the income statement treatment, and you can see these two columns for old versus new treatment are almost identical, other than just the terminology changes on the first row. Moving on to operating leases, this is where the bigger changes are happening. Alex, if you could go to the next slide, please. So here, the first column shows the old operating lease accounting. The middle column represents the new operating lease accounting for ASC 842. And then the right column shows how existing operating leases will now be recognized for GASB. And I know we're really focusing on ASC 842 here, but just wanted to show you guys the changes in GASB in case anyone here is impacted by the GASB standards. And one important thing is that while FASB chose to retain a distinction between finance leases and operating leases, GASB did not. So under the new GASB standards, operating leases no longer exist. They'll become finance leases. And so the accounting in the right column here is really exactly the same as the old capital lease accounting. So for operating leases, the major change you can see on the first row is that operating leases now will have an asset and a liability on the balance sheet. On the income statement, for FASB, there's no change from the old standard. So you can see in that second row, you still have straight line lease expense being recorded under both standards. And this is again due to the fact that there are still two different types of leases under ASC 842, that it really ends up just being a balance sheet impact. So while you will likely have a large change to your balance sheet, your income statement will be pretty consistent with prior accounting. So if we move to the next slide, we talk a little bit just about the differences in accounting between finance leases and operating leases. Under the new standard at the beginning of the lease, there's no difference between a finance lease and an operating lease. For both types of leases, you'll recognize a lease liability, and that's at the present value of the future lease payments. And then you recognize a corresponding right of use asset. Then for the ongoing expenses, for finance leases, the right of use asset will get amortized similar to a fixed asset. And then interest expense will get recorded on the liability. And then for the operating leases, again, there's only the straight line lease expense that's getting recorded as an operating expense. And you'll see also there's a difference in the cash flow statement treatment between the two types of leases, as payments for finance leases are financing cash flows and payments for operating leases are operating cash flows. So again, there's really not a change here in the expenses and the cash flow statement compared to the old standards. There are still two types of leases, and it's really just a large impact to your balance sheet. So everything that we've talked about so far has been related to the lessee side of accounting. And this is because many of the criticisms with the previous lease guidance were around the accounting for the operating leases for lessees, since those were off balance sheet. So for the FASB, addressing those concerns with the lessee accounting was the main focus of the changes in the new standard. And so ASC 842 really does not change lessor accounting. There were some minor changes made to conform some of the new wording with lessees for lessors, and also to conform with other topics like ASC 606 for revenue. But overall, in most situations, you should not see any impacts there. Touching on GASB, GASB did make potential changes to the lessor accounting. So if you are impacted by GASB, be aware of that. So now that we've covered what's changing, what should you do to get started on implementing the standard? So first, we recommend reading the standard, attending trainings like this to get an understanding of what will be changing for you. And then identify someone on your team to lead your implementation efforts. Next, we would recommend reviewing your debt covenants or reviewing any other contracts that may be impacted, because since this will likely be a large change to your balance sheet, it could affect different ratios or other covenant calculations. So you'll want to make sure you're aware of all the impacts this could have, and then talk to your bank or others as needed to make sure that they can either update your covenants or be prepared in other ways and know what to expect with these changes. So then once you have a general idea of what changes will be needed, you'll need to determine if you think the full implementation can be completed in-house or if you may need outside assistance. And Chase will talk about this a little more later. And then finally, make sure you're educating anyone who may be using your financial statement so that they aren't surprised when they see this big change. You'll also want to make sure that your board or other leadership is aware of the time and resources that may be needed to complete this project. So we're going to move into the second polling question now. Have you started the process of understanding and adopting the new standard?
And then again, I think while everyone answering those questions, the polling questions, I think it's a great opportunity to get some of the pre-questions we've had so far. And Jessica, to you again, just kind of one of the questions we got from audit perspective is, what kind of documentation will auditor require as it relates to journal entries when you think about 842 from auditor's perspective?
Yeah, good question. So as an auditor, I can give you what my perspective is. I can't promise this is exactly the same things as what your auditors might be asking for. I think from an audit perspective, first we want to understand overall, what have you done to adopt this? What was your process? How did you make sure that you had identified all leases? How did you go through all of the different practical expedients? Which ones have you chosen? Just really getting a full view into what you've done to adopt the standard. And then we would want to understand all of your calculations. So did you use a software? And if so, can we see that? Can we get all of the calculations? Because we'll want to be tying things out and testing things. And this is where it does get a little easier if you are using a software, because a lot of times that can all just come from the same place. Otherwise, you would definitely want to be providing the different Excel calculations that you've done for us to be able to test the ending balances.
Got it. No, perfect. Thank you. Looks like the results are in, and again, it looks like we have a mixture between understanding and adopting. Yes, I have a good understanding and identified internal resources, and yes, I understand, but I've yet to identify. Both of them came at 35%. Sounds like there's a great opportunity here for those who have a great understanding of the process, but have yet to identify the resources. Really, focusing on a lot of part of the presentation when we talk about processes or approaches to implementing. And then lastly, no, I don't have a good understanding, and hopefully that 24% after this call, it starts to feel a little bit better about the codification itself. Unfortunately, there is no more delay. So that 24% there, we definitely want to make sure we start to push that into the understanding piece. And then lastly, the 6%, which is good, I think is still a bit high, but less than I expected. No, I'm still hoping there's another delay. And unfortunately for that 6%, there is no more delay. FASB did have earlier in the year, had one more meeting for a potential private company additional delay that was denied down. So this is our date is set. We're required to be adopted from a private company standpoint. Adoption date 1/1/2022. So from a financial perspective, and this is actually one of the polling questions that impacts me from a disclosure standpoint, is my 12/31/2022 and any interim reporting periods within the fiscal year 2022. All right, moving on.
Awesome, and I'll go ahead and jump here in now, Alex. I appreciate everyone's input so far, but now we want to talk a little bit about applying this actual new lease standard. So Jessica walked us through, what is it? What is the differences? What are the changes? Well, now we want to understand, once we identify that, and we need to know what our leases are. And so in this section, we're going to really talk about the front end and the back end. So we're going to talk about how to identify a lease, what are some of those key factors to make sure we have all of our leases understood. We'll talk about embedded leases in that, again, to make sure we can get that full, complete, accurate portfolio. And then we'll talk about the end. So once we have that and we get to that 12/31 year end, what are we looking at as far as disclosures go? So first of all, we want to look at a definition of a lease, and there's a few key points I want to pull out of this. And so obviously you'll see here, it's a contract, which is going to be important. It conveys control. So we'll dive into a little bit of what that control aspect will mean. And it's of the right to use another entity's asset. So again, that right to use is a specific thing we want to discuss. And then again, has specified in the contract for a period of time. And so that period of time is another key piece we'll talk a little bit more about, because that is such a gray area of really what that period of time will look like. And so again, that's going to be an exchange of things like transaction. So again, I want to call out this contract here, right? So we're looking at a non-financial asset that's legally enforceable, right? Written or verbal, and then an exchange or exchange-like transaction. And then there's that control. This is where you have the actual control of the right to use that asset. Now, not all the benefits and not the actual ownership. You'll see at the bottom right, if you actually are having that ownership transferred to you, that's really no longer a lease and really should be a purchase or sale financing option. But you want to make sure that, first of all, you have a contract in place, and then you have control. And that's where you'll really start to determine where you begin to think, hey, we might have a lease here, because you do have the control of that asset. So some key points to focus on here. Next, we'll think about, once we have determined that we have a contract in place and we have control of that, we want to think about the time, right, and the actual length of this contract. And so we'll talk about that here on this next slide. And so discussing this, there's a lot of pieces here where we determine the lease term. And there's a question that popped up around, in our chat around short term, right? And how, if we can scope those out, right? Well, determining what the full lease term is going to be really important in identifying what that is. And so there's different aspects to this lease term. First of all, we have to identify a non-cancelable period. So if there's a period in that term or in that lease that can be canceled by both parties, then that is the end of your lease, right? Because past that, we can't be certain that you have a term past that non-cancelable period. First of all, you want to identify those non-cancelable periods. And then you want to identify any periods covered by an option to extend. So those are really important, and under this new standard have gained a significant importance, because if you'll see here in the asterisk, if you determine that you're reasonably certain to take that option, you're actually going to include that in your initial assessment of that lease. So for instance, right, if I have a 5-year lease, we've determined that's the non-cancelable period, and I have another 5-year option. Well, under the standard, if you're reasonably certain to exercise that additional 5-year option, you now have a 10-year lease. So that can be, very important, because flip that on its head. If you have a, 6-month contract with 2 6-month options to extend, maybe just by itself, that non-cancelable period would be a short-term lease, and hey, we can scope that out. But if you're reasonably certain to take those 2 options, now you have a lease that is having financial impact. So it can have serious financial impacts, when you're determining this actual lease term. So it's very important. Now, that reasonably certain piece is always a fun one to think about, because it's somewhat gray, right? Because the standard doesn't really give definitive answers as to far as what can make you reasonably certain. There's no threshold, there's no percentage threshold specifically stated out. But what I'd say in practice is we see, as long as you have some type of justification, right? Maybe it's historical, maybe it's a market consideration. I was talking to someone the other day who they're going into a new market and they have a lease in that market, but they don't know anything about it. So they're going to say, hey, we're not going to take that option. That's a reasonable validation, right? Hey, we're going to test this market out before we determine whether we're going to take this option to extend. So, understanding that justification and document, I think that's important to document, so your auditors can, confirm and say, okay, that is an option that you're extending, so we can confirm that that term is accurate. So sorry to jump down that rabbit hole, but I think it's just a really important piece to think about when you're understanding those extension options. Now, the same thing comes into play when you're thinking about termination options. So if you're reasonably certain to not take that termination option, then you can include that, right? If you are reasonably certain, as of the date that you're reasonably certain to take that renewal or that termination option, right? That's the end of that lease. Even if it goes for another 10 years, after 5 years, if you're reasonably certain, right, that's the end of that term. Another piece that you'll need to be considered is any periods that are subject to that fiscal funding clause. Okay, awesome. So now we've talked about some of those terms, and now I think I have a good understanding of, well, how do I identify a lease? I know the definition. I know, how I can determine the lease term and all those different pieces. And so if it is going to turn out to be a long-term lease, right, you have to consider that into your financial statements. Now we need to consider how that's going to actually affect our disclosures. And we've highlighted this a little bit in the beginning, that there are significant changes to the amount of disclosures that you're going to have to be considering. So we'll talk about the lessee side here first. And we'll first look at the statement of financial position. So in this statement of financial position, we need to present, right, the financial position separately for both your asset and liability, and really separately between your finance and operating leases. You'll see here, take your finance and operating leases and separate those out for the right of use asset and the liability for all four. Now, if they're not presented separately, disclose which line items in the statement of that financial position include the actual right of use asset and the liability. Because if you're not presenting those separately, really a lessee is precluded from presenting the finance lease asset in the same line as the operating lease asset, and the same thing goes for the liability. So when you're considering this and going through the presentation in the statement of financial position, really make sure you classify that right to use asset pretty consistent with how you have in your PP&E, right? The similar depreciation of those assets there is how you'll go about presenting that asset for your leases on the financial position, on the statement of financial position. And then also for your liabilities, you want to make sure you're breaking those out as current and non-current, right? So identify that short-term and long-term piece of that liability, and present that in similar ways that you do your other financial liabilities here. So now we've touched on the statement of financial position. I think we may have skipped one slide here. Perfect. Now we'll talk about the statement of comprehensive income. So for finance leases, you want to present that interest expense, right? Jessica talked about for those finances, you'll have that interest and depreciation aspect. But you want to make sure you present that interest expense on the lease liability and the amortization of the right of use asset really in a consistent way that you do your other interest and depreciation expenses respectively, right? So 842 doesn't really provide specific and clear guidance on presentation of variable lease payments though. So when you're understanding those expenses, right, those are clearly stated out, that interest and depreciation for your finance leases. But a lot of people think about those variable lease payments and think that, oh, maybe I can just not consider those. Well, it doesn't give specific guidance on how to disclose those, but you still will need to disclose those. So common way we see is just presenting those as that lease expense or interest expense may be appropriate. But still make sure you are tracking those variable lease expenses because you will have to disclose those. So that's for the finance side. For the operating leases, that lease expense is included just in the income from the continuing operations, right? The great thing about operating leases is that, sure, the board made us put them on the balance sheet, but they didn't make us track that interest and depreciation, right? So it's not affecting that EBITDA calculation. So any of those operating expenses, you'll just track those as lease expenses in those continuing operations, and really should be classified in the SG&A. But you'll still need to as well track those variable lease expenses for operating leases too. So still make sure you're disclosing those. The final piece we would talk about for lessee side is that statement of cash flows. So for finance leases, you'll classify those repayments of the principal, so the principal reduction, right, within the lease liability, and then you'll classify the interest on the lease liability, really in accordance with that ASC 230. Now, for operating leases, classify payments within operating activities, really except if those payments represent cost to bring another asset to condition, right, and location. So if you have those fees to transport your vehicle to location, those really should be listed as investing activities. And then for all leases, again, we talked about those variable lease payments. Classify those variable lease payments and short-term lease payments that really aren't captured in that lease liability within operating activity. So another piece to consider, we hear this a lot. Hey, do I not have to worry about variable lease payments or short-term leases, right? Because they're being scoped out of the standard, or they're not hitting my balance sheet. Well, you still need to make sure you're tracking them, again, because they are being required to disclose on the in the notes disclosure. So don't ignore them. Make sure you're tracking those, and then again, just track those within the operating expenses within the cash flows. And finally, the establishment of the asset and the liability. You'll do that as of commencement. So that's a little different, can be different between GASBs, but when you're establishing the asset and liability, do it as of commencement, especially when you're determining short-term and long-term as well. That information is as of commencement, not as of transition. And then again, this should be disclosed as non-cash investing and financing activities in accordance with ASC 210. So that's the lessee side of this. The lessor side, we'll really think about from the statement of financial position, those sales type and direct financing leases. So not your operating leases for the lessor side, but those sales type and direct financing. You're going to have to present those lease assets, right, separately from the others, and then classify lease assets as current or non-current, right, consistent with the way similar assets is classified, just like we've talked about above. And then your operating leases for the lessor side, you'll present that underlying asset subject to an operating lease and any lease receivable, right, in accordance with ASC 310. Now, for the lessor side, you have that statement of comprehensive income. So for all of your leases, present that income arising from leases separately. Talked about this in the lease sides, right? You need to present that separately, or specifically disclose which line items in the statement include that lease income. So for all of your leases, right, when you think about the asset and the liabilities, make sure you're distinctly breaking that out. You can't just group that in with your fixed assets or something like that, right? You need to have that separately listed out. And then for those sales type and direct financing leases, present that profit or loss, right, recognized again as a commencement date in a manner that reflects the lessor's business model. And you'll see some examples below. The next and final piece here is that cash flow. So just classify those cash receipts from the leases, right, just within the operating activities, regardless of lease classification. So all of the cash receipts from your lessor activity is just going to flow within those operating activities. However, though, lessors within the scope of ASC 942, so financial services, depository, and lending, should classify those separately. So now we've talked about all the separate disclosures. Let's quickly discuss the embedded leases. So I just want to sandwich all this together here. We've identifying those embedded leases, a really common situation that we hear about, because this is an area that's so uncommon. We don't really understand it. And so there's really 4 key parts that we want to test. First is there an asset involved? So if you have this service contract, maybe it's not the explicit thing that you're paying for, but is there an asset involved? One I always love to bring up an example, because I was just thinking it's quirky and funny, is that trash pickup services. That could be a situation to where you have an asset involved, right? You're paying for the service to come empty your dumpster, but maybe part of that contract includes them providing you a dumpster. So now in that contract, there's an asset involved. That dumpster is an asset and has a value. So in this case, we'd say yes. Well, is there implicit identification or explicit identification? Right? If it's explicit, then you have to understand if there's a right of substitution. So can the vendor substitute that out at any point in time? Do they have a financial incentive if they were to substitute that out? Right? So those are some factors to consider. But if they don't, then you have to understand, well, do I have the direct use of it? Am I the only one that could use it, or is it maybe it's a shared keep on my quirky example, is it a shared dumpster, right? And then can you derive all the benefits? So if you have all the benefits, that's that control test, right? We have the use of it. We can direct when and how we use it, and then we get all the benefits. If that's the case, you got a lease, and then you get to disclose that on your financial statements and have all sorts of fun disclosures in your note statements too. So a lot of factors to consider, but use this as a guide here, right? Walk through this yes or no decision tree, identifying whether you do have a lease under the new standard or not.
We're having our third polling question. And this question is, how do you plan to implement and adopt the new standards? Few choices here. First, you can outsource to a third-party CPA firm. We've done hundreds of these. So a CPA firm like a Cherry Bekaert. We also co-source. We try to be nimble with our solutions, and so we co-source. You may have the in-house talent to do it, and you may be planning to do it on your own. And then the fourth is not sure yet. So if you can answer the polling questions, you need to answer 3 of the 4, I believe, to get the CPE. Maddie, is that right? So
Yes, that's
answer
correct.
away.
And while, again, while participants are answering questions, I thought it'd be a great opportunity to answer some of the questions we saw coming in. There's one question I wanted to answer live to the group because I thought it was very, very helpful. There was a question from one of the participants regarding, how do we address when the discounted lease payments are greater than the asset value? And obviously there's other accounting implications to this particular standpoint where my discounted lease payments may exceed my asset value, and there's some implied interest and other things around there. But from an 842 standpoint, what that tells me is that that particular lease is going to fall under a financing lease. So the impact for 842 would be the classification. That's the point. Obviously, because the actual lease payments are greater than asset value, there are other codification impacts, but from 842, it is a classification issue. All right, looks like we got the results in here. Looks like 45% of the participants will be doing a full in-house implementation. It tells me you guys have a great understanding, which kind of goes back to the other poll, having a great understanding of starting to implement. 27% doing co-sources. This one is really a combination between in-house personnel as well as a third-party CPA firm like a Cherry Bekaert and so forth. And then lastly, 23% not sure yet. So for the 23%, obviously, again, as we noted on our early time, there are no more delays. If there's anything that we can do to help you kind of address or get over the hurdle, by all means, definitely hopefully this presentation will kind of push you toward the approach you want to take. And then lastly, the 6% is outsourcing directly to a CPA firm.
And so now we get into the practical, how do we adopt the standard? And this is the approach that Cherry Bekaert has used, and it's something that we just developed from, again, many iterations of helping companies with this. And this isn't meant to be something that we would perform exclusively. It is meant to be an approach that the 45% of you who are performing your own in-house implementation could follow. Generally speaking, just going through this, we suggest, having we always think that some training and an initial discussion around planning for the implementation is important. So here you would talk about the different lease items that exist and start to do an inventory of your leases. Do you how centralized is your operations? Do you have any contracts in other locations? Do you have complete knowledge of where leases may exist? If you have multiple locations, you may not. And so how do you centralize this? So just getting an entity-specific overview of the universe of leases. And from that, you can start talking a lot about next steps. And so then, again, we think it's important after you really have had just some preliminary planning to think about software We had some questions earlier regarding where do you find the most errors? You know, we find a lot of errors when you try to manually adopt the standard, frankly, from creating spreadsheets that attempt to adopt the standard. You know, if you have more than a few leases, that's really not a good sustainable alternative with the cost friendly software packages that are out there. You know, it's not as if you're implementing an ERP. They're very customized solutions, and they're very reasonably priced so they can help get over the hump and help you maintain this software. Help you maintain the compliance with this standard. And so we would then suggest that you have really a go live call that is 1 hour where you really talk about gap. Okay, great. We know kind of where these leases are. Let's now get into how it's likely to impact us. For example, how many leases do you have that are in excess of 12 years of a year where you may be scoped out of the standard? Oh, we have 300. Okay. Do we have all of them? Are any that complex? Do we need help analyzing any of those? And then you assign out responsibilities and a timeline. We use Smartsheet for an implementation plan. Then we would suggest before you make the next decisions that you really do a deeper dive into any complex leases. Now, what do I mean by that? You know, you probably can think about what they may be. A complex lease might be, oh, well, you know, there's a lease agreement on some buildings that have some strange escalation clauses. Perhaps you have any real estate lease can get a little more complex. Perhaps you have some leases from an acquisition that you inherited. You're not very familiar with them. You need to kind of get familiar with those. Because then you can adopt some practical expedience, but the challenge with the practical expedience is it's really an all or none election. So you need to really understand your universal leases pretty well before you decide whether to adopt a practical expedience. Most of our clients do, because it is a friendly package of practical expedience, but it's not right for everyone. And then Wesley described these renewals. That really becomes a new estimate in your financial statement, how long you'll renew your leases. And accounting may not know the answer. So you're going to have to really coordinate to get the answer to, you know, how long are you likely to be in a lease from an economic perspective? It's more of a business decision. Jessica talked also about the discount rates. That's an important driver of this calculation, and it's not going to be something you can put together in an hour. Sometimes it takes a lot of back and forth and thinking about. I mean, you need to give that a process to really determine that. So all of that really needs to be done before you start to implement input numbers. And again, generally we think a software package is the right way to go. And there's very friendly user interfaces to input into a software package. There's also review tools that you can establish as part of your system of internal controls so that you have a preparer of the lease inputs and a reviewer. Many auditors will then expect you to write a memorandum around your GAAP implementation as part of your audit so that they can understand some decisions that you made along the way and what you concluded, especially for complex leases, for your discount rates, for your renewals. They're going to have to audit this. So while you're making these decisions, you would really be remiss not to capture that information. And so then you get to really the end of the process where you can start to quantify the impact on the financials through a journal entry. I'm telling you, these lease products are great. They will frequently provide a journal entry to you. If you input your account numbers, you'll have an account number with the journal entry. So it becomes very manageable. You're going to have to update this every year. And so, or if if you need to report more frequently to a board or to investors or, related to a debt covenant more frequently. So that's a very user-friendly option for sure. The financial statement disclosures are plentiful, and those are also provided in the lease software. So, but that's kind of a latter step. And then there may be some communication that you have to do with the board or perhaps with a note holder where you have some covenants, or perhaps with your investors. So that's something you want to consider. When you start to have discussions around this and you think about your resources, think about how familiar you are with the standard and the rest of the organization. Is there a need for training? You might as well engage in these software discussions to determine what these prices are, because they're not overly expensive to an organization. You need to start understanding the number of leases that exist. That way you can really price out software and think about options that may be right for you. Whenever you start having lessors, instead of just being a lessee, the standard can become a little more complex, especially if you are in a financing type relationship and that goes on the balance sheet. So you need to think about your subleases for sure, figure out quickly, are they financing type, and if so, that may require different product. Again, those discount rates, this is very important that you get a good rate. I would have collaboration with your auditor about your approach quickly. Debt covenants, you don't want to go south with those based on something new on the balance sheet. And then related party and intercompany leases, you might want to think about those and think about your rates inherent in those leases. Intercompany leases are not scoped out of the standard. So if you have any statutory reporting, you're going to have to reflect those leases in your financial statements. So quickly on to the next slide. Action items before what we call a go live call, or you might think of this as where you get started. Inventory those leases. Where are they? How do I figure out, how many my 10 subsidiaries have? Is it centralized? How good is legal about keeping it all in one place? Perhaps you're a simpler organization, so there are only a few folks who can enter into a lease. Figure out your inventory. Your service contracts, there could be embedded leases in a contract. We have to really think through this. Your auditor will be all over this, thinking through, okay, great. I have an arrangement with an office supply company that includes a copier. That's a real simple example. Is there a lease? Or perhaps I have some landscaping performed for me and they have some equipment on site. If you have a larger plant, is that a lease? Is that equipment leased? Could be. Capturing data. Do you have? We talked a lot about these renewal options. Who in the organization makes those decisions, and how can they weigh in and provide information to you? You don't want to wait for that. You need to have them start thinking about that. Think about various other items. Contingent rent becomes a little complex, percentage rent, and the like. And then which software provider to use. What I'll say is that anywhere along the way, if you need a third-party advisor, you might consider reaching out to either your accounting firm or another CPA firm that's been through a lot of these, just to have the dialogue. We've become very nimble in how we help clients. Some clients are down the road and they just need some advice. Other clients they've gone down a bad road. They need a lease rescue effort. We can help you with that. We can test your calculations if you've done it manually. This is a complex standard. I would suggest that you consult along the way. We generally, this describes our approach. We can help you with just basic services, and a lot of other CPA firms can as well. So let's say that you have 5 leases and you just need some guidance along the way. Well, we can help you with that. We can also help you find a good software product. We have partners such as Wesley and others. Perhaps you're limited like a lot of accounting staffs and just do not have the manpower to get this done. If you have a lot of leases, we can take this off your hands and really provide a robust solution. If you're an audit client, there's certain independent standards we'll have to talk to you about and how we monitor that. And then lease accounting services, generally speaking, the lease software is not a one-time benefit. There is an ongoing maintenance benefit. It becomes a very routine part of your close once you have a software product. So, in general, this is our experience serving clients. Again, we can help you think about software options, kind of give you a gauge of pricing. Different vendors are better for different companies, just depending on how many you have. We can help you identify that population, making sure it's complete, thinking about your purchase arrangements. Did we talk to IT and figure out what assets they may have? Surely they have some servers and some other things. Perhaps you have a off-site facility with with a network or storage off-site. So do you just not have good feedback and you need to go in and do a search of your expenditures for essentially embedded leases? We can help you. Or is your auditor asking for that based on your internal control structure? And then one thing that we frequently do is we will use a hierarchy of leases A, B, and C as to the complexity. And perhaps if you have some really complex leases, let's call those the A leases, you review all of them. If you have some that are similar but have some complexity, perhaps you just review a few and make some decisions based upon that one lease, or based upon the population that you review and apply it to the rest. Or perhaps you have very basic leases and there's not a lot of review that's needed. So generally, a transition memo may be needed. And so these are just some things that we've done to assist clients here. And we can move on to the next slide. So what do you do now? Again, can't emphasize enough that accounting may not have all the answers. You're going to have to engage others in the organization, be it facilities, procurement, IT. You're also going to have to think through your service arrangements, your right to use assets, and really inventory your complete population. And then get into the details, get into the accounting, analyze those agreements and understand the accounting changes. And then you're ready for the next step, the adopt step. And then also from that, your disclosures, which are, again, can be time consuming. And so, the next question is around the lease software. Have you chosen a lease software? The answers that we have here, no, not planning to use one. I'm planning to go a manual route. The next is not yet, but I need to. The next is I'm right in the middle of that process. And the last is, yeah, I've made that decision.
And while the poll is going on, guys, I did want an opportunity. We have several questions out there around the lease piece. And I think the last section of the webinar is going to cover that. I know we have 5 minutes left, so we'll make sure we cover that quickly. But a couple questions come about. How can you recommend a couple software providers? We do have several partnerships with several software providers we can help recommend. I think what's coming through this next section, that question is going to be answered fairly easily. Another question that came about is, at what number do I start to determine, should I use the software? As Chase alluded to, and we're telling clients anything more than 5 leases, we're suggesting use the software, just because at this day and age, the software industry, it's very cost efficient. The price of the software is very economical, feasible, even for a small middle market company. It's going to save you and your team a tremendous amount of work on trying to keep up with the auto renewals, any remeasurement periods, rather than, the potential for material misstatement using Excel spreadsheets obviously is significantly higher, which on the back end is going to increase your audit costs. Whereas if I've only got 5 leases, let me throw it in the software, let the software do all the thinking for you. And each of the softwares are covered by a SOC 1 report. So it looks like we'll go ahead and end the poll here, but it looks like the results of the poll, about 35% are no and not planning to use one. I really want to talk to that 35% here, and I hope to show that after this next slide deck, we really can reduce that number. And I'm telling you guys, one of the questions that happen is, what are some of the pitfalls that you've seen going through adoptions of the public companies, adoption of the government companies? The biggest pitfall I've seen where clients are making the biggest mistake and risk of the biggest material misstatements is not using the software. That is you'll find out as you get through this, not using software. And the reason is because of the treatment of those renewal options and the timing of when those renewal options become reasonably certain, and when there's a change in lease payments. All those type of accounting events require remeasurements. The next one is currently 31% currently evaluating options. So hopefully after this next piece, we can get through that. And then lastly, not yet, but planning to, and then 60% yes. With that being said, I'll turn it over to Wes for the last piece on the software piece.
Awesome. And you made some great points there, Alex. And I think some of the biggest pieces that we've shown today is that this standard is complex. There's a lot to it. And a software can just be so beneficial to, first of all, just take the burden off of the individual, just to be the expert, right? You don't have to be an expert if you have a software that is the expert for you. And so, you can find ones that have integration with your ERP, right? You can handle multi-entities, handle both lessee, lessor, short-term, all sorts of pieces here. And then obviously cost is probably always the number one question people ask, right? But again, we here at Lease Accounting partner with with Trey Bekaert, and you have multiple options there, right? But when you are starting to determine whether, hey, should I just do it in Excel or should I go to a software? There's just a lot of benefits because there's limitations there with Excel, right? Excel can't provide guidance-based guardrails. Like that's what I'm talking about. This standard is complex. There's so many nuances. A software can put up those guardrails to make sure you're in line and don't have those misstatements down the line. Give you some examples, right? Short-term lease evaluation. So some softwares can help identify that, right? You can have a collaborative database. So Chase mentioned it multiple times, right? This is not going to be just within accounting, right? You're going to have the full organization involved, and so you can have softwares that you can have that multi-level of access so that IT, legal, real estate, whoever may be want to can be involved in that process as well and find efficiencies there too. And then employee turnover. Most common situation that you can be concerned about is that if you have an Excel, this one individual is, the one that's driving your evaluation or driving that Excel sheet, but they move on to the next job. Well, now someone else has to learn that Excel sheet, has to learn how the standard, make sure they are able to understand that. So, and then time is the most valuable thing, right, in the world probably. And just having that automation for all of your different pieces can just be incredibly beneficial. Also, the last piece really is just control environment. Controls are so important just to make sure that you don't down the line have those misstatements, those material deficiencies. And so having separation of duties, right? Software like Lease Accounting can help with that, where you have the breakout between who's entering a lease and who is reviewing it, who's making those changes and who's reviewing it. You can have that action tracking. So you can have an audit trail within the system to make sure that everything is happening appropriately and by the appropriate individuals. And then departmental access, right? So technology can centralize data and segregate departments so they can just focus on what they're involved in. So you really, there's all sorts of offers out there, but really you need to find that specialized lease solution, right? Technology that's purpose-built for this standard. I mentioned again, I'll say it again and again. This standard is so complex and so difficult. So find a software that is purpose-built for that. And biasly, that's what Lease Query is here. But you know, what can you get? You can get automation of amortization schedules, journal entries, disclosures, automate comparative periods, key date reminders, right? Reporting abilities, and then just most common word that here, just comfort and ease, right? Ease of use, and just feel comfort that I don't have to be an expert in this standard, because the software can help automate that for me.
Thank you again, everyone, for joining us today. Chase, Jessica, Alex, manning the chat for us. And of course, Wesley, we appreciate you being on here for today. If you have any questions, you will see the contact info on the slide in front of you. And again, thank you again for being part of this webinar today. And we look forward to talking to you again soon.